and welcome to our live session today with Peter. So, what's been happening in the FX market?
Well, we had a slight weakening of the US dollar. It seems that dark clouds have started to surround the US economic outlook. I would be noting, though, that we may have gotten also some hawkish, slightly hawkish comments from Fed policymakers. Those Cleveland Fed President Mester, or say, for example, Fed Board Governor Cook, Boston Fed President Collins, all seem to be tilting towards one more rate hike at least. So that was a little bit hawkish, and it's expected that should the Fed continue with its monetary policy tightening, we may see an adverse effect, an additional adverse effect, on the US economic activity. So that's an issue on a more fundamental level. I would be noting, though, also that from across the world, from New Zealand, we had RBNZ's interest rate decision. The bank was surprisingly hiked rates by 50 basis points. The market was expecting a 25 basis points rate hike. The bank was more hawkish than that. And that tended to provide some support for the Kiwi. I would be noting that in the accompanying statement, the bank more or less tended to remain rather confident, which may imply that more monetary policy tightening is to come, and that may provide some additional support for the Kiwi. Other than that, I would be noting also that we had an interesting movement from the British pound yesterday. It strengthened considerably against the US dollar, and it wasn't only a USD-driven movement of cable, it was also a sign of a strengthening of the pound, despite actually getting some mixed signals from BOE policymakers yesterday. We had BOE's Tenerero, which provided a more dovish view, given that she stated that she expects an earlier rate cut in this year. While on the flip side, BOE's chief economist, Philip Lane, tended to highlight the necessity for the bank to continue hiking rates in order to curb inflationary pressures. It seems that investors are more or less placing a greater degree of confidence in the UK economic outlook, or at least are not so pessimistic anymore about it.
And how about US stock markets?
US stock markets dropped. They practically snapped, if I'm correct, a 3-day winning streak. So that was a bit of an issue. I would say that more or less the release of the JOLTS job openings, which dropped below 10 million for the first time since May 2021, tended to unnerve somewhat stock market participants. I would also be highlighting JP Morgan CEO Jamie Dimon, which practically stated that the banking crisis in the US is still not over. It was an issue which the market had started to reassure themselves, but given Jamie Dimon's comments, market nerves resurfaced and practically tended to exercise some downward pressure on US stock markets. Other than that, I would expect that should the market sentiment continue to be lukewarm or even deteriorate further, we may see US stock markets dropping even more, be deeper in the reds today, and we may expect that to be maintained up until the US employment report on Friday.
And how about gold?
Gold jumped. Gold jumped, if I'm correct, $45 in a day per ounce. It was a substantial jump. It was more than we expected, definitely. Okay, there was some strengthening of gold was expected as the US dollar started to weaken, but $45, that was out of our expectations. Nevertheless, we tend to see the case for gold's price to rise, but that's conditional in the sense that the negative correlation between gold and the US dollar takes precedence, which implies practically that most probably gold's moves will be dependent on the US dollar.
And what's new regarding oil?
Oil remained at rather elevated levels, or its WTI's price remained at rather elevated levels. I would be noting that we had a surprise drawdown reported by AP, which was quite wide, substantial, which more or less tended to highlight once again that the US oil market remains rather tight, given that demand levels were able to surpass production. So I think we may see the bullish tendencies for oil's price to be maintained. How I would like also to see how EIA's crude oil inventories figure will be released today.
And what's on the calendar in today's European session?
We already had from Germany the industrial orders growth rate. It was expected to slow down, it didn't. It actually accelerated substantially. That was a positive for the euro. We already had also the final PMI figures from the Eurozone and the UK. Other than that, it was a rather quiet European session.
How about the American session?
Well, in the American session, we have a number of releases. Definitely after the release of the JOLTS job openings yesterday, I think attention will be turned also towards the US ADP national employment figure. It's expected to drop. A number of investors are considering the indicator as foreshadowing also the NFP figure. We do not actually agree with the correlation of the two, but nevertheless, that's something which is out there and should be mentioned. Should the ADP figure actually drop, that could weaken the US dollars. That would imply further loosening of the US employment market. I would be highlighting, though, the ISM non-manufacturing PMI figure. It's for March. And I'm highlighting because 2 days ago we had the ISM manufacturing PMI, which showed a widening contraction of economic activity. Now, the picture about the economic activity in the US economy is practically going to be completed also with the ISM non-manufacturing PMI figure today. It's expected to drop. Should it drop more than expected, we may see the USD weakening once again, as that would imply further slowing in the expansion of economic activity. Other than that, I would be highlighting from Canada the trade data. And the trade surplus is expected to narrow a bit. Could cause the loonie to slip, as that would imply practically that the Canadian economy benefited less from its international trading activities. And last but not least, as we have mentioned before, oil traders may be focusing actually more on the EIA weekly crude oil inventories figure. Should there be another substantial drawdown, that could provide some support for oil prices.
And in tomorrow's Asian session?
Actually, we have 2 releases of interest. I would be definitely highlighting Australia's trade data. Now, should the trade surplus actually narrow, that may cause the Aussie to slip. While later on we're getting from China the Gaixing Services PMI figures for March, may have a low impact on the Aussie, but still it's noteworthy.
Thank you, Peter. Stay tuned for our next live session with Peter.
So, welcome to the technical analysis part of the presentation for today. My name is Peter Joseph, Senior Market Analyst at IronFX. In front of your screens, you have the US dollar index. It's the 4-hour chart. All charts to be presented, mind you, are to be of the same time frame unless otherwise stated. Now, with no time to waste, definitely we note the wide drop and the stabilization afterwards of the US dollar index. the index was able to finally break clearly below the S100 and 155, which leads us practically that we have to switch the role of the S1 and turn into a resistance line, given that the price action is clearly below it. Let's go hunting for a new ultimate resistance support level. Unlocking the chart. Let's go back to find a suitable throw. I would be noting this one. It has also support and resistance levels. That would be the 98.85. Let's color this in green. Locking it in. Readjusting the chart. Repositioning the labels. Let's also correct the labels, starting with the R3, which is now being placed at 103.05. The R2 at 102.45. The R1 at 101.55. The S1 at 100.65. The S2 at 99.80. And the S3 at 98.85. We check the S3. This is relatively fresh. Yep, 98.85. Okay. So the bearish tendencies seem to be enhanced. The RSI indicator of the 4-hour chart is now at 36, which is quite low. Note also how the 20 moving average, the 50, the 100 moving average are pointing downwards. The downward trend line remained intact. Overall, all of that tends to constitute further signals that the bearish movement most probably will be continuing, despite the possibility for a correction higher. I wouldn't be surprised to see that and then continuing even lower towards the 100.65 support line. For a stabilization of the US dollar index in the sideways motion, I would expect it to remain at the same or a little bit higher levels, near, if not just above the 101.55, which could be signaled also by a possible breaking of the downward trend line we have just mentioned. On the flip side, should the bulls clearly take over, we may see the price action of the US dollar index rising, breaking the 101.55. Also, a clear break of the downward trend line would be required in order to signal exactly the ending of the downward movement or the interruption of the downward movement. Yet for bullish outlook, I would require also the price action to reach as high, maybe even breach the 102.45 resistance level. I would require a higher peak than this one. Okay, let's move to Euro USD. That was a mess. Let's readjust the chart. That's better. Now, interestingly enough, we saw Euro USD jumping, breaking above the 1.0925, and I dare to say that it's a clear-cut breaking. So we tend to maintain a bias for the bullish outlook of the pair, given also that the RSI indicator is actually quite high. It's at 64.8. Okay, it may not be that high, but definitely it's more towards the bulls rather than the sideways motion. Now there is a stabilization, which should not be neglected. Should the bulls though maintain control, we may see the price action aiming for the 1.1125 resistance line. Mind you that the motion seems to be more USD related rather than Euro strength related. So I would be on the lookout for any movement of the USD and then see how that compares to the Euro against the US dollar. Should the stabilization be maintained though, we may see the price action remaining just above the 1.0925 support line. Now for a bearish outlook, we would require a clear drop, breaking of the S1 1.0925, but also breaking of the upward trend line, possibly with the price action aiming for the 1.0760. I would require for a bearish outlook something very concrete, actually a lower true than this one. Let's delete this. It's interesting how it has formed a high true, once again forming the upward trend line. Let's clear the chart. Now, moving to cable. Bullish sentiment here seems to remain strong. Note the widening of the Bollinger Bands, the upper and lower Bollinger Band. Note also the RSI indicator, which remains very, very close to the reading of 70. It's actually right now at 68. Both of these elements plus the clear-cut upward trend line tends to keep the bullish outlook alive for cable, and that may allow it to rise, break above the 1.2590 and start aiming for the 1.2775. Now, the recent stabilization over the late American, today's Asian, and early European sessions tend to imply that a sideways motion scenario is also possible. We saw that in the euro as well. And in this case, we may see the price action remaining between the 1.2590 and the 1.2435. For a bearish outlook, I would require a clear-cut breaking of the S1 1.2435 and the price action to break also clearly the upward trend line, guiding the pair since that should be mid-March. Let's have a look. Yep, the 15th of March. So a drop, breaking the S1, breaking the upward trend line, and possibly testing the S2 1.2265, which provided beautiful support here, resistance here, and here, and here, would be required here. Let's have a look at USD/JPY. USD/JPY, let's readjust the chart just a bit. Okay, it has dropped, broken the 132.55 support line. Now we have to turn into resistance line. And then stabilized. Let's go hunting for a new ultimate support line. I think this one. Definitely not this one. It's too close to the S2. You can see how it also provides support here, resistance here, support here. Seems to be valid. Let's color this in green, and it's going to be the 1.2635 line. Readjusting the chart. Let's reposition the labels. Let's correct the content of the labels as well. There are 3 now. It's being placed at 137.80. There are 2 at 135. There are 1 at 132.55. The S1 at 130.40. The S2 at 128. And the S1 at 126.35. Let's reaffirm. So give me a sec. Locking everything in. So despite the drop, we see the drop practically, okay, it's a little bit unconvincing. I would see the drop continuing before actually calling in the bears here. For the time being, I tend to maintain a bias for a sideways motion between the 132.55 and the 130.40, especially given the stabilization here. I would be noting though that the RSI indicator remains quite low. It's not that low, it's actually at 42.4. But we note that we have one peak, the second peak is lower, one show, the second show is lower. There may be some slight bearish tendencies here. But for a bearish outlook, we would require a drop, a breaking of the S1 130.40, which practically would be paving the way for the 128 support level. On the other hand, for a bullish outlook, we would require the pair to rise, break the 132.55, and start aiming for the 135 resistance level. For the time being, though, we tend to maintain a bias for a sideways motion to continue between the R1 and the S1. Definitely the fact that the price action remains in a rather tight range-bound movement since yesterday's late American session and throughout today's Asian session is not exactly convincing of high volatility. On the other hand, though, we have to note that we had a wide drop yesterday, which forced the Bollinger Bands to widen as well. So that could be an issue. Once again, sideways movement expected for the time being. Let's have a look at the other safe haven currency pair. That would be USD-CHF. Sorry. So we had a steep drop, far lower than the 0.9115 support line, which now is being turned into a resistance line. Okay, let's go hunting for a new ultimate support level. Locking the chart. Let's go back. Way back. Okay, we have some movement here. That would be a nice true. Could go even lower. Somewhere here. Yep. And we had to go way back. Actually, we're talking about a true which is being set at 27th of January. And we're talking about 2021, if I'm correct. And sorry. Let's color this in green. It's going to be the 88.60 support line. Readjusting the chart. Repositioning the labels. Starting with the R3, which is now being placed at 0.9335. The R2 at 0.9220. The R1 at 0.9115, given that it has been clearly broken now. And the S1, which is currently being aimed for, it's a 0.9020. The S2 at 0.8935. And the S3 at 0.8860. Okay, for the time being, the bearish sentiment seems to be pretty much alive. I would be highlighting that we had downward movement, which seems to be. And one could actually discuss whether we have a steepening of the downward trend line, like this. The RSI indicator is at the reading of 30. It's actually right now at 29. Let's have a look. No, 32. So there is the bearish sentiment, it's present. Note how the pair has stabilized after hitting, actually breaking, the lower Bollinger Band, which tends to imply that the bears maybe slow down a bit, but there's still some distance to cover up until the downward trend line, and the distance between the price action and the low Bollinger Band is increasing slowly but steadily, building up. I wouldn't be surprised to see the price action maintaining its downward motion, breaking the 0.9020 and start aiming for 0.8935. On the flip side, should there be a relative stabilization of the pair, probably above the S1 0.9020, we may see the price action breaking the downward trend line, exactly signaling the exit of the pair's price action from the downward motion. While for a bullish outlook, despite being probable, it's still a possibility and it should be covered. We may see the price action rising, breaking the downward trend line, possibly breaking, not possibly, definitely we would require a break of the R1 0.9115 and the price action to start aiming for the 0.9220 resistance level. For the time being, we tend to maintain a bearish outlook for the pair and expect it to break below the S1. Let's have a look at the Aussie. Now we can see the Aussie weakening, yet overall the movement tends to remain a little bit unconvincing here. It's still in the range of the wide sideways movement the pair has had since around the 13th of March. So, in our opinion, for a bearish outlook, we would require a clear break of the S1 0.6625 and the price action to start aiming for the S2 0.6520. Mind you, and this is interesting, we have an RSI indicator which was at the reading of 70, dropped, hit on the reading of 50, corrected higher, yet dropped again, breaking the 50, and is aiming lower. So the bearish sentiment is slowly building up, but it's there. And that could be maybe the main driver behind further losses for the Aussie against the US dollar. On the other hand, should the pair stabilize, we may see it maintaining a sideways motion between the S1 and the R1 as it has over the past 3 weeks. For a bullish outlook, we would require the pair to reverse direction, take another swing on the R1 0.6755, and this time start aiming, if not even reaching, the 0.6855. Okay, let's have a look at USD CAD, which had an interesting movement during today's European session. Here you are. So we see USD CAD rising and actually breaking the downward trend line which was guiding it. And that was since the 24th of March. For the time being, okay, definitely we have to switch our bearish outlook given that the downward trend line has been broken. Given also that the RSI indicator has risen and is nearing the reading of 50, implying a rather indecisive market, we tend to maintain a bias for a sideways motion to continue between the 1.3520 and the 1.3365. On the other hand, for a bullish outlook, we may see the price action rising, breaking the R1 1.3520 and start aiming for the 1.3665. Now, should the bears take over, which may be a little bit of a surprise, but it's still a possibility and should be covered, we may see the price action dropping. We would require a lower truth on this one, so it has to reach, if not breach, the S1 1.3365 and start aiming for the 1.3230. That would allow us to draw a new downward trend line. Let's have a look at the Kiwi as well, as we had RBNZ's interest rate decision today. Let's have a look at the movement caused by the surprise double rate hike for RBNZ. Here it is. It was a beautiful interruption which practically pushed the pair higher. It was of around 76 pips. 77, yeah. Very, very nice move, clear-cut upward movement caused by the double rate hike, which was not expected. The market had expected a 25 basis points rate hike. RBNZ delivered double that amount. Now back to the forward chart. You can see that practically the pair has corrected lower and has reached prior levels. The RSI indicator has subsided from the reading of 70 and has dropped to the reading of 58, which is actually not bad, but definitely it seems to imply that the bulls are losing their effect and their influence on the market sentiment. For the time being, I would expect some stabilization of the pair, but I wouldn't be surprised to see the bulls taking over once again. Should that be the case, we may see the price action rising. Now this time we would expect another clear break of the R1, 0.6360, and the pair to start aiming for 0.6460. On the other hand, a relative stabilization of the pair may cause it to remain confined between the levels set by the R1 0.6360 and the S1 0.6270. So it would be a sideways, wide sideways motion like this. Should the bears take over, which is also a possibility and should be covered given the wide correction lower, we may see the price action dropping, breaking the 0.6270 and start aiming for 0.6190. For the time being, I would like to drill into the 1 hour chart. Actually, the half hour chart would be even better. Okay, there's the correction intensifying during today's European session. A relative stabilization as well, but it's very, very slight. It's going to be an interesting development of the price action, whether it's going to be turning back up again or whether it's going to remain rather sideways. Moving now to gold's price, which had a considerable jump yesterday. You can see it right now. It was an impressive jump. Actually, let's measure this once again. It was $45 if I'm correct. Yep. Back to the 4 hour chart. Widening it. Okay, the price action has clearly broken the 1994 and has just now broken above the 0.2021. I'm going to be changing both of these levels into support lines. Note how it is nearing the record high level of 2075. In our chart, it's being noted by a slightly lower peak, which was at 2070. Setting the next resistance lines at 2100. It's a quite clear psychological barrier. And even higher at 2130. Adjusting the chart. Let's readjust also the labels. Reposition them at first and correct them later on. Starting with the 1960 as being the new ultimate support line. 1994 being the second support line. The S1 first support line, which has just been broken, is going to be set at 2021. We make a wide jump, reaching all the way out to the 2070 resistance line. With the psychological barrier, given that 2075 was an all-time high for gold. So we're setting the new psychological barrier at 2100 and then moving to the 2130. Locking everything in. So what's the story here? Regarding direction, we're clear-cut bullish. And the reason is A, the upward trend line. You can see with the touches, there was a slight correction here and then jumped higher. We have a very strong bullish sentiment. Note how the RSI indicator is right now above the reading of 70. It's actually at 72.8. So that's one. I wouldn't be surprised though to see some correction lower, given that gold's price may have reached overbought levels. But as long as the upward trend line remains intact, we tend to maintain our bullish outlook. Note how the jump practically forced the Bollinger Bands to widen, and now we have seen a more intense upward movement by the 20, the 50, and the 100 moving averages, but especially the 20 moving average, which is more sensitive due to the shorter tail. So, should the bulls maintain control over gold's price, I wouldn't be surprised to see it aiming for the 2070. Mind you, though, that the fact that the price action was able to break above the Bollinger Band slowed it down. I would expect to see some, I wouldn't say consolidation, but still some stabilization of the pair up until it builds some distance with the upper Bollinger Band before actually jumping once again. Now, should the precious metals price drop, possibly definitely break the 2021, but also break the upward trend line we have just drawn, yet respecting the 1994, that would be a signal for a possible sideways movement between the 2021 and the 1994 levels. On the other hand, should the bears take over, we may see the price action dropping, breaking the S1, breaking the upward trend line, breaking the S2 1994, and start aiming for the S3 1960. I know it's wide, as is the R1 pretty wide, but given the movement which gold's price had shown yesterday, it's possible. And I think it would be even more clear cut if we see the daily chart showing us the movement within 24 hours. You can see how exactly gold may produce sharp upward or downward movements. I'm not saying that's usually the case, but it's possible. Back to the forward chart, zooming out, moving now to Dow Jones and US stock markets. Quick glance, the first drop in 4 days. Let's drill out to the daily chart. Whoa, it's far more than that. 1, 2, 3, 4 days. We had a drop which was more or less markable. It's something which you could see, and note how the slight bearish tendencies are being maintained also today. Definitely the clouds surrounding the US economy and doubts tend to reduce the confidence of stock traders to the outlook of the US economy, and that tended to push towards the downward side. And I would be also noting the fact that we had a number of Fed policymakers yesterday which made some hawkish comments implying that more rate hikes are coming, possibly another 25 basis points rate hike, and that would imply an additional strain on US economic activity, which may be pushing US stock markets lower. It's characteristic that the price action is dropping, and so is also the RSI indicator. We are now in the forward chart, which is the RSI indicator is now nearing the reading of 50 to 55 with a downward slope. Wouldn't be surprised to see it breaking the 50 barrier. And similar movements are observable also on the S&P 500. This is the daily chart, 4-hour chart, but also Dow Jones, no, also Nasdaq. Once again, the daily chart, albeit it's less sensitive. Back to the 4-hour chart. Let's have a look also at WTI prices just before we leave. Okay, interesting element. Okay, WTI prices seem to stabilize, hitting a ceiling around $81. In our case, it's the 80.9 resistance line, the R1. The RSI indicator was clearly above the reading of 70, yet seems to be dropping. It's actually threatening to break the reading of 70 from upwards towards downwards, aiming slowly but steadily towards the reading of 50. It's actually now at 70 still. But we may see the bullish sentiment more or less fading away. On the other hand, the financial releases, especially AP's yesterday and maybe today's EIA, may imply another tight US oil market for the week, which could keep oil's price at elevated levels. For the time being, we tend to maintain a bias for the sideways motion to continue just around or below the 80.90 resistance line unless something a little bit more dramatic happens. In which case, should the bulls take over, I wouldn't be surprised to see the price action of WTI rising, breaking their 80.90, definitely escaping the area of $80 to $81, and start aiming, if not even reaching, the R2 86.75. It would be interesting to see where that actually rests. And that would be near the mid-November last year. Yeah. So we're talking about the possibility of reaching a 5-month high should it reach the R2. On the other hand, should the bears take over, we may see the price action of WTI dropping and testing, if not even reaching the S1 74.35 support line. Mind you that the level, the S1, was tested extensively. It was tested here, 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 here. Okay, here there was a breach. So there were extensive tests both to the upside as well as to the downside. It's going to be an interesting read to see how the prices of WTI are going to be reacting on a fundamental level as well, but also on a technical level. Note how the moving average are all pointing upwards for the time being, but the commodities price has stabilized. They're failing to actually catch up on this due to the tails. It's interesting how the 20 moving average crossed the 50 moving average, while the 50 moving average, which is in green, was able to cross above the 100 moving average, which is in orange. All of that tend to be bullish signs. Also, the fact that we had Bollinger Bands which narrowed but are pointing upwards, that's another sign. On the flip side, the RSI indicator seems to be dropping. It's actually threatening right now to break below the reading of 70, implying that the bullish effect most probably may be fading somewhat away and may allow WTI's price to drop a little bit further. That should sum it up from all of us here at IronFX. Best wishes for solid trading.
to another of our videos. Today we'll be looking at a gap. So, what is a gap? A gap is an area on the chart where the price of an asset moves sharply up or down. There is little or no trading in between. As a result, the bar or candlestick chart shows a gap in the normal price pattern. Traders can exploit these gaps for profit. Basically, gaps occur because of underlying fundamental or technical factors. Gaps can appear in the forex market, but they are less common than in other markets because currencies are traded 24 hours a day, 5 days a week. However, gaps can occur when economic data is released that is a surprise to markets. Also, gaps can occur when trading resumes after the weekend or a holiday. Although the forex market is closed over the weekend, the market is still open to central banks and related organizations. So, it's possible that the opening price on a Monday morning would be different from the closing price from the previous Friday, which results in a price gap. The difference between the open and closing prices is the gap. If Monday's open price is higher than Friday's closing price, the price gapped up. If Monday's open price is lower than Friday's closing price, the price gapped down. There are 4 types of gaps. The first one is known as a common gap, which represents an area where the price has gapped. The second type is a breakaway gap, which occurs at the end of a price pattern. It signals the beginning of a new trend. The third type is a continuation gap, also known as a runaway gap, and occurs in the middle of a price pattern. This gap type signals a rush of buyers or sellers who share a common belief about the price future direction. And the fourth type is known as an exhaustion gap, which occurs near the end of a price pattern. It signals a last attempt to hit new highs or lows. Thank you for watching.
Okay, just a disclaimer. The information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. Okay. So this material is just a personal opinion of the authors and the client's investments objectives, and risk tolerance have not been considered. Okay. IronFX is not responsible for any loss arising from any information contained. So redistribution of the material is strictly prohibited. Okay, I think I might have a setting that I need to change. Okay, wait. Okay, give me a moment. Setting up. Okay, let me continue. Kindly increase your volume. Yes, please increase the volume. I think I'm speaking at the max as loudest as I can already. So let us begin. So I'm actually from Everest Fortune Group, and my name is Chen Yongjing, and I'm the trade analyst for the company. We are the finalists for the best Forex research for 2019, 2020, and 2021. We are also the finalists for the best equity research for 2020 and 2021. So right now we actually have a special collaboration with IronFX, where we are bringing you guys the good stuff. So IronFX right now, you can actually go to ironfx.com. For those who do not know, you can go to the website. If I'm not wrong, IronFX School under webinars listed as popular. You can see the, let it load first. Okay, you can see the, okay, I'm not sure why my face is not up here yet. All right, it's okay. So you can actually see the upcoming webinars. Wait, let me find the, okay, over here. We have the timetable for the upcoming webinars that you guys can actually attend. So right now is this webinar is live. So feel free to check this link out. So by the way, I know some of you guys want to contact me outside of this webinar. So feel free to check out my link tree. So this is actually a quick guide about myself. You can actually check out my Instagram, my YouTube, my LinkedIn profile. Feel free to follow me. All right, let us begin. So today will be a shared webinar. It will be with myself, Yongqing, and Sarah. So at the second half of this webinar, Sarah will be taking over. Okay, let us continue. So a few topics to cover today. So we'll be covering on, let me pull this chat around. We'll be covering on basics of news trading, key news events to watch out for, how each news event affects the markets, and 3 types of news trading strategy. So today will be a very, very dry lesson. So be prepared, get your coffee. I won't be showing much technicals. Today is all about the news, all about fundamentals. It might be boring, but it will help you a lot in a basic understanding of how news events actually affect the market, how you can bank on it to, scalp or either take a long position. So coming up first, 4 main factors to consider. Firstly, it's crucial. Okay, you can see a few points here, news events to pay attention to, what news events you want to pay attention to, and the expected data. So you want to also check the price reaction from previous news release. So firstly, it's very crucial to keep track of news events. I'm reading these points. And expected data releases. Economic indicators such as GDP, let me write this down, GDP, unemployment rates, inflation, can significantly impact currency values. Therefore, keeping an eye on the economic calendar and being aware of upcoming news releases can give traders like you guys an edge in predicting the market movements. So secondly, the price reaction from previous news releases is also an essential factor to consider. Traders can analyze how the market reacted to previous data releases and use this information to make educated guesses about how the markets will respond to future releases. So doing so, what you can do is you can go to Forex Factory. Let me show it to you. Can head on to Forex Factory. I'll send the link to the chat, so it's under calendar. Feel free to check out this link. Forex Factory, head on to Forex Factory. You start to look at all the news events. For example, tonight we have the United States dollar, core retail sales month-on-month, Empire State Manufacturing Index, retail sales month-on-month. So you do not know what does it do, how does it affect the markets. So what you can do, you can read a quick summary, click on it, read how it usually affects, what you can have a summary change in total value of sales at the retail level, excluding automobiles. Can read more details about it. Go back to the forecast. So I think the more important one is core retail sales. So you can go back to the previous data release, which is on September 15, 2022. Go to your chart, click on it, start to go back and see how the news event actually impacted the United States dollar. So go head on to your DXY chart. Negative 0.3% versus previous 0%. So September 15, we can take a look at it. Let me load out my layout. Okay, so we'll be going through on core retail sales month-on-month on the DXY chart. Okay, DXY. So let's go back on the daily chart. September 15. September 15, right here. So notice upon the news release, price actually caused price to continue moving up in the long run. So you can actually start to look at maybe the 4 hours or 1 hour chart, want to see what happened on September 15. So September 15 around at night, price actually shot up before heading back down. You can start to check a reaction, what it does, hits up first, clears the previous high. So every different news release is very, very different from each other. So find out the characteristics. First, it went up, cleared the previous high, went back down, tapped into some kind of support. So you back test it and back test this. I'm just giving you a very, very basic example. So you start to move on. I wouldn't be showing everything. So you'll be moving on to October 14, 16, December 15, January 18. Start to look at all this data, how it affected, how price moved. Get into accounts. Please do not just jump right in and try to trade the news event tonight just because you did some quick back tests on core retail sales and retail sales, Empire State Manufacturing Index. So moving on, back to the charts. Okay, back to the PowerPoint. So current trend, why is it very important? Okay, current trends in the markets are another crucial aspect of Forex trading. Traders can use technical analysis tools to identify trends, such as moving averages or trend lines. It's essential to know whether the market is trending upwards, downwards, or sideways, as this will influence trading decisions and risk management strategies. So last but not least, support and resistance levels is still very, very important in Forex trading. Important to consider. So these levels actually represent price points at which the market has historically shown support or resistance. Traders can use this information to determine where to set stop loss. So you can use it as a gauge stop loss and where to put your take profit level. Okay, moving on next towards the news events and expected data. So we actually have a very nice, clear screenshot of Forex Factory. So as Forex traders, it's very essential. Okay, before I continue, so we are actually focusing on the AUD. So right here, this specific news event is what we are focusing on. So as Forex traders, it's very essential to place close attention to the economic calendar and be aware of any upcoming news events and expected data releases. Firstly, these events can cause significant market volatility, which can lead to increased trading opportunities. For example, if a news event indicates that a country's economy is improving, traders might buy that country's currency, expecting it to strengthen. So as a result, the value of that currency might increase, creating a trading opportunity. Okay, secondly, moving on to the expected data part. News events and expected data releases can provide valuable insights into the health of an economy. So these indicators can help traders understand how a country's economy is performing and whether it is growing or contracting. Traders can use this information to make informed trading decisions, such as deciding whether to buy or sell a particular currency. So third points that we want to go through. News events and expected data release can influence central bank decisions on interest rates. So we have the Bank of England, the Reserve Bank of Australia, etc. So can influence central bank decisions on interest rates, which in turn can affect currency values. So central banks actually use interest rates to control inflation and stimulate or slow down economic growth. So if a central bank announces a change in interest rates, it can impact the currency value and create trading opportunities. So last but not least, news. So just to summarize overall what I've just talked about this entire slide. In summary, news events and expected data releases actually help traders to manage risk by providing insights into the potential impacts of specific events on currency values. So for example, if there is an expected data release that could significantly impact a currency, traders might choose to exit a trade before the release to avoid the potential volatility. So this is why I do not trade 1 hour, about 1 to 2 hours before the news release, or 1 to 2 hours after the news release. So personally, I avoid that just to prevent any mishaps in my trading accounts. I do not want my trade to potentially cause slippage, potentially hit my stop loss, just because I wanted to be greedy and try to trade the news. So we are looking at the Aussie dollar, Australian dollar right here. So we had a cash rate. So they actually increased the interest rates. So previous was 1.35%, the forecast 1.85%, and the actual was also 1.85%. So what happened? Let's take a look how the news impacted the Australian dollar. So Australian dollar chart. So every time Australian dollar had a 50 BPS hike on the 7th June, price went down. 5th July, 50 BPS hike, price went down. 2nd August, BPS hike, price went down. 6th September, 50 BPS hike, price went down before going back up and continued going down. So we already know we have a data set, we have proven data on the charts. Data do not lie. So every time we have a news release like this, we can expect to possibly sell Australian dollar, AUD, USD, every time we have a cash rate news event coming up. So please screenshot this down before I continue. So I've already helped you done most of your homework, maybe for this specific news event. Please screenshot this down before we continue. Okay, moving on next. So I'm just zooming in on the 5th July. I'm zooming in on this right now, on this specific day that actually happened. So I cannot remember specifically because I actually did quite a number of research. So zooming in on the 5th July, 50 BPS hike, price went up, cleared the previous high right there before it, moved down all the way down towards the previous swing low, and it actually formed a support right there. So you already know price goes up first before heading down. So please screenshot this down before we continue. This is still related to the previous slide that I just showed you guys. Okay, next. The 2nd August 50 BPS hike. You notice that price also went up first respectively right there on a smaller time frame. It then, after the news release, immediately went down towards the previous support level. So every time we can expect price to likely head up first before the news release, before potentially just continue heading down towards the next key support level. Okay, moving on next to the key news events to watch out for. So we actually this is quite a long slide that I have to go through. So there's a theme of economic focus on what happened in the past, how it affected the markets, all the fundamental drivers that affected. First of all, going through the global financial crisis. It happened during the 2008 to 2009. Then the economic focus was a lot on employment data and wage growth. So for those who do not know, the global financial crisis is also known as the Great Recession. So it had far-reaching consequences for economies and individuals worldwide. It was triggered by a combination of factors, including subprime mortgage lending, a housing market bubble, and excessive risk-taking by financial institutions. So the crisis actually resulted in widespread job losses and had a severe impact on the employment market. So the unemployment rate in the United States, for example, it rose from 5% in 2007 to a peak of 10% in 2009. So many companies struggled to stay afloat, and as a result, many workers lost their jobs. Additionally, the crisis had a knock-on effect on other economies, leading to job losses worldwide. The crisis also had a significant impact on wage growth. As unemployment rates rose, employers had less incentive to offer pay rises or bonuses, and some even cut wages. So in the US, wage growth slowed from 4.4% in 2006 to 1.8% in 2009. So let me draw it. 4.4% in 2006 to 1.8% in 2009. So it made it difficult for many individuals and families to make ends meet. Okay, let me write this down. Unemployment data, 5%. 2007, it moved to a peak of 10% in 2009. So the global financial crisis had a domino effect on the world's financial markets as the interconnectedness of the global financial system became evident. Financial institutions that had invested heavily in mortgage-backed securities and other high-risk assets faced significant losses. And many banks and other financial institutions went bankrupt or required government bailouts. The crisis also prompted significant government intervention. Central banks around the world cut interest rates, and governments introduced stimulus packages to try to prop up their economies. However, it actually took several years for the global economy to recover fully from the crisis, and many countries are still feeling its effects. So overall, the global financial crisis was a watershed moment in the world economy, with far-reaching consequences for individuals and economies worldwide. The crisis had a very severe impact on employment and wage growth, leading to a significant job losses and slower wage growth. So the financial markets and central banks all had to take unprecedented measures to address the crisis, and its effects are still being felt today. Next, we have the COVID pandemic. I guess we just got out of it. So now is the post-COVID. So COVID happened 2020 to 2021. All of us went through it. The pandemic had far-reaching consequences for individuals, economies, and societies worldwide, and its effects will be felt for years to come. So one of the most significant impacts of the COVID-19 pandemic was on the gross domestic product, the GDP. So which is actually a measure of a country's economic activity. The pandemic led to a massive decline in economic activity as many businesses were forced to close or operate at reduced capacity due to lockdowns and restrictions. So the International Monetary Fund, the IMF, estimated that the global economy contracted by 3.3% in 2020, the most significant downturn since the Great Depression. So the pandemic also had a significant impact on employment. Many people actually lost their jobs due to business closures or reduced hours. The unemployment rates increased in many countries, and the number of people working part-time or on a reduced pay also rose. So as a result, many individuals and families experienced financial hardship, making it difficult for them to meet ends meet. The pandemic had very, very significant consequences for healthcare systems, with hospitals, healthcare workers overwhelmed by the sheer number of COVID-19 cases. Governments around the world had to invest heavily in healthcare infrastructure, including building new hospitals and acquiring medical equipment, such as ventilators and personal protective equipment, PPE. So moreover, the pandemic had a profound impact on global supply chains, with disruptions affecting industries such as manufacturing, agriculture, and logistics. Travel restrictions and border closures also led to a decline in global trade, affecting economies worldwide. So overall, governments and central banks around the world responded to the pandemic by implementing fiscal and monetary policies to support their economies. Many countries introduced economic stimulus packages, and central banks lowered interest rates to encourage borrowing and spending. So right now we have the 2023 recession that is coming up. So we'll be focusing on inflation data and interest rates. So this recession was triggered by several factors, including inflation, rising interest rates, and the COVID-19 pandemic. So inflation was one of the most significant factors contributing to the recession. So in many countries, inflation rates reached historic highs due to supply chain disruptions, labor shortages, and rising commodity prices. Commodity is wheat, corn, rice. So high inflation led to increased costs for businesses and consumers, causing a decline in purchasing power and economic activity. Interest rates were also a contributing factor to the recession. Central banks have raised interest rates in response to the rising inflation, which made borrowing more expensive for businesses and individuals. So higher interest rates also led to a decline in consumer and business spending, reducing economic activity. Okay. Give me a moment, let me get a cup of water. Okay, the COVID-19 pandemic also had an impact on the recession. The emergence of new COVID-19 variants and the resulting restrictions led to reduced economic activity and job losses. Many businesses, particularly in the hospitality and tourism industries, were forced to close or operate at reduced capacity, resulting in a decline in economic output. So the recession is leading to a significant increase in unemployment rates in many countries, and many individuals and families experience financial hardship. So governments are responding to the recession by introducing stimulus packages and implementing monetary policies to support their economies. Central banks around the world lowered interest rates and introduced quantitative easing measures to support the economy. Governments also introduced fiscal stimulus packages to support businesses and individuals. So these policies actually help to stimulate economic activity and support job growth. So this is just for general information about what has happened in the past 15 years or so. Okay, let me see what's next. Okay, non-farm and employment change. So this is a very, very important thing. It actually occurs on the first Friday of the month. Okay, one of the most closely watched, okay, just these 3 points, screenshot it down. It's related to the change in number of employed people during the previous month, job excluding the farming industry. So this is only for the United States only. Only US, it's not anywhere else in the world. So job creation is an important leading indicator of consumer spending, which accounts for a majority of overall economic activity. So it's also a high price volatility event. So NFP, also known as non-farm payroll, is a key indicator of the health of the US economy and is closely monitored by traders, investors, and policy makers. So NFP measures the number of new jobs created in the United States, excluding the agricultural sector. The report is released by the US Bureau of Labor Statistics on the first Friday of every month and provides insights into the strength of the US labor market. So the NFP report provides 2 pieces of information: the number of new jobs created in the previous month and the unemployment rate. The number of new jobs created is a crucial indicator of economic activity, as job growth typically leads to increased consumer spending and overall economic growth. The unemployment rates, on the other hand, provides a measure of the health of the labor markets and can influence central bank policy on interest rates. So the NFP report is considered a leading indicator of economic growth and is closely monitored by traders and investors. A better than expected NFP report typically leads to a rise in the US dollar's value, as investors anticipate increased economic growth and the possibility of higher interest rates. So a worse than expected NFP report, on the other hand, can lead to a decline in the US dollar's value. So as investors become less optimistic about economic growth and the possibility of interest rate increases. The NFP is also closely monitored by policymakers, including the Federal Reserve. The Fed uses the NFP report to determine whether to raise or lower interest rates. So with higher employment rates, it actually leads to higher interest rates. Okay, please screenshot this down before we continue. Okay, next. Moving on towards interest rate decisions. So central banks hike interest rates to increase the cost of borrowing. It slows down economic activity. These are the main important points only. Please screenshot it down. It reduces or slows down the speed of inflation and is also a high price volatility event. So interest rates are a crucial tool that central banks use to manage inflation, economic growth, and financial stability. Interest rate decisions can have a significant impact on currency exchange rates, stock and bond markets, and individual financial planning. So interest rate decisions are made by central banks, which are tasked with maintaining price stability and supporting economic growth. Central banks can adjust interest rates up or down depending on economic conditions and their policy objectives. A rise in interest rates can reduce consumer spending, lower inflation, and support a currency's value. A cut in interest rates can stimulate borrowing and spending, support economic growth, and weaken a currency's value. So interest rates are typically announced after a meeting of the central bank's monetary policy committee. The announcement includes a statement that outlines the central bank's reasoning behind the decision and any future policy changes. The statement can provide insights into the central bank's outlook on the economy, which can influence financial market expectations and individual investment decisions. So it can have a significant impact on financial markets. A rise in interest rates can lead to a decline in the stock markets as companies' borrowing costs increase and consumers may reduce their spending. So higher interest rates can also lead to a strengthening of the domestic currency, making exports less competitive. A cut in interest rates, on the other hand, can lead to a rise in the stock markets as companies' borrowing costs decrease and consumers may increase their spending. Lower interest rates can also lead to a weakening of the domestic currency, making exports more competitive. Okay, let's move on. So the inflation data, the CPI. So the consumer price index, so it actually measures the change in price level, indicates the change in the cost of living, and the target CPI for the economy is 2 to 3%. So please note this down. This is very, very important. Please screenshot this down. So the CPI measures the average change in prices paid by consumers for a basket of goods and services over time. So it's a crucial indicator of the health of an economy and is closely monitored by policymakers, investors, and consumers. So inflation is the rate at which the prices of goods and services increase over time. A high rates of inflation can lead to a reduction in the purchasing power of money, making it more expensive to buy goods and services. On the other hand, low inflation can lead to deflation, which can harm economic growth and create disincentives for businesses to invest. So the CPI is used to measure inflation and is one of the most commonly used indices. The CPI calculates the average price of goods and services, including food, housing, energy, healthcare, and transportation. Mind my writing. It's a bit hard to write using the pen. So changes in the CPI can over time provide insight into the rate of inflation. So the CPI is released on a monthly basis, closely monitored by policymakers and investors, provides insights in the state of the economy, and can influence monetary policy decisions. Okay, so high inflation leads to a rise in interest rates, which can increase the cost of borrowing and slow down economic growth. Low inflation can lead to a lower interest rate, which can make borrowing more affordable and stimulate economic growth. So inflation data also has an impact on individual consumers. A high rate of inflation can lead to increased costs for everyday goods and services, which can reduce consumers' purchasing power. Low inflation can lead to lower costs for consumers, making it more affordable to buy goods and services. Okay, let's move on. Right now, Sarah will be taking over. So yeah, let's welcome Sarah. I'll be taking my leave.
Hi everyone, my name is Sarah. Okay, so today I'm going to take at the second section of this webinar. So just now Yunjin has mentioned it. Okay, so for the Kiwi dollar, the CPI news is really important. So now let's take a look at the next slide. It's about how the give me a moment. let's take a look at this slide is how the news is affecting our price and how the price is reacting towards the news. Okay, you can see before the news come. Sorry, where is my mouse? Okay, here. Can you see my mouse? Okay, so you can see before the news come, there is a very nice steadily ascending trend line. So the price is going to react it according to the trend line. Okay, and you can see before the news come, the price is more in a consolidation, means the price isn't moving very much. Okay, so it's more like up and down, but in a more horizontal way. But you see at the 6 p.m., the news have come out. Okay, so the news will affect the price of the market. That's why the price has shooted up. Okay, shoot it until where? Shoot it until the period swing high. So always take note when we are reacting towards the news, always looking for a reference point. Don't always say that, oh, the price may go up to here or the price may go up to here. Okay, you need to find a reference point, which is very important. Most likely the reference point is the period swing high or the period swing low. Depends on how you judge the news going to affect the market. Okay, next one. Okay, so you can see here are all the news. Here are all the news of the. Here are all the news of it's very important news on the 13th October. So always. Okay, so always remember the news event. You need to pay attention and the expected data. Always pay attention on the current trend, okay? And always pay attention on support and resistance lines. So their price is going to reaction after from the previous news release, okay? So you need to take it as a reference. Okay, so here you can see there is a news coming up. I think it's at before the price is consolidation. So you can see the price didn't move a lot. After the news release, the price has shooted up and now retreats back. So how each news event affects the market? So for short-term effect, okay, so there are some news will affect it in a more short-term term. So for example, employment change, retail sales, and purchasing manager index. So later at 9:30 p.m., there are retail sales for USD. So maybe later we can pay attention to it and we see how the news is going to affect the market price. So employee change is a very key indicator of economic health and have short-term effect on our trading. A strong employment change report can indicate a growing economy and increase customer confidence, leading to a stronger currency. In another scenario, okay, a weaker employee change report can indicate a weaker economy, leading to a weaker currency. So most likely the employment change is correlated to the currency. So if employment change is good, okay, so the currency is going up. If otherwise, it will go down. So how about for retail sales? Retail sales are another economy indicator, indicate that short-term impact on the trading. So retail sales measure the total amount of goods and services sold by retailer. And a strong retail sales report can indicate increased customer confidence and spending. This can lead a stronger currency. as the investor become more optimistic about the economy. A weaker retail sale report, on the other hand, can lead to a weaker currency, as the investor become less optimistic about the currency. So this one same as employment change. Okay, retail sales good, currency go up. Retail sales bad, currency go down. So lastly, the PMI. Okay, so PMI is a survey of purchasing manager in manufacturing sector that measure the level of business activity. The PMI can have a short-term effect on forex trading. It provide the insight into the strength of the manufacturing sector and the overall economy. A high PMI indicated increased manufacturing activity and growing economy, leading to a stronger currency. So in alternate scenario, a low PMI will indicate a weaker economy, leading to a weaker currency. So all three of these are very correlated to the whether the strong or weak is the currency. So the better the number is, the better the currency. The weaker the bad the number is, the weaker the currency is. So bear in mind, so this three factor is only going to affect the currency in a short term, which means after the most likely after the news has been released, within like a few hours, or like within a short term, the price will be changed according to the news, but it's unlikely to going to affect the currency in long term. So now let's take a look at what will affect the currency in a medium to long term. What are the factors? So first one, very straightforward, is GDP. And another one, secondly, is the CIP. And lastly, the interest rate decision. So let's take a look at GDP, okay? GDP is a measure of country economic output and is considered one of the most important economic factor. GDP measures the total value of goods and services provided within a country border and provided insight into overall health of the economy. A high GDP can indicate a growing economy, which means a stronger currency. A low GDP indicates a weaker GDP and lead to a weaker currency. So imagine the news has released like United States, the GDP has went up, which means the price of the currency will go up. So secondly, let's talking about inflation data. Inflation data as measured by Customer Price Index, CPI. So it's another key economic indicator that can impact forex trading over medium to long term. A high rate of inflation can reduce the purchasing power of the currency, leading to a weaker currency. In other hand, low inflation can lead to stronger currency, which indicates a stable and growing economy. So lastly, our interest rate decision. Interest rate decision are also important indicator for our trading. So central bank use interest rate to manage inflation and support economic growth. A rise in interest rate can lead to a stronger currency, as the investor may be attracted to a high interest rate. Most they want to deposit in that interest rate, or because it's high interest rate, I can deposit over and to gain more interest. So in alternate scenario, in alternate scenario, a low interest rate means less demand of the money, which means the currency may be dropped. So this three factor, or this three related news about this three factor, is going to affect our currency in a more medium to long term effect. So imagine that this kind of news has been released, okay? Maybe the price may not move like a lot, but in the future or in a more mid to long term, the price is going to react to these factors. Now let's take a look at news trading strategy. Means how are we going to enter in a trade by the news or like according to the news? So there are three different kind of trading strategy. Firstly, entering before the trade release. So most likely we are looking at 1 hour or 15-minute chart. So what meaning by entering before before the release means we are predict on the numbers. Imagine like later the retail or the US retail news going to release. Okay, so let's just make a prediction whether the news is good or not than compared to the previous one. Okay, so if you are considering, okay, I have confidence in this, okay, the news is going to be good, means better than before. So this you may enter in the trade in a long position, which means I think, okay, USD will go up. So the goal is to catch the maximum move following the news release. Because you are entering the trade, most likely you are putting a buy or sell limit before the news release. So the strategy can be very dangerous as the trader can take advantage of significant price movement. However, there is a risk of being backed off as the market can react unpredictable to the news release, which means maybe the news may be good, okay, but the market did not respond in after the news come. So maybe the news good, but the price still dropping down. So maybe it will hit your stop loss. Then finally, the market has reacted to the news. There may be a chance in this kind of scenario. So how about our second strategy? Our second strategy is using pending order. This involves placing an order ahead of news release. Okay, so it's more likely using a 1 hour chart. The strategy has less emotional involvement. Okay, so as the traders set their orders and wait to the market to fill them. However, there is a risk of price spillage, as the market can move significantly after the news release, causing the order to be filled at a different price than expected. So our third strategy is to reacting to the news release. So means after the news release, we are reacting, we entering the trade according to the news. Most likely we are using 15-minute or 1-minute chart. So this involves the trading you used it on 15-minute and 1-minute chart. Trader wait for the news to release or to come out. Then they react based on the price movement. This strategy can be beneficial as the trader can react to what they are seeing in the market. However, there is a risk of being influenced by price movement and making irrational trading decisions. So each strategy has its own set of good advantage and disadvantage. So when we are entering the trade, think carefully to see which one is best fit your trading strategy. And also always remember, manage your risk. Trader must be prepared to accept the loss and have a solid risk management strategy in place before you enter in any trade. Okay, so that's all of today's webinar. Is there any more questions? So by the way, later at 9:30 p.m., there is a very important news on USD. So maybe you guys can pay attention on it. How would you feel the USD going to react? Okay, so if no more questions, I may just end today's webinar. Thank you, Edrica Das. Thank you, Iram Atadi. Thank you, Mogizi Likope. And thank you, Steve Code. Okay, forgive me if I pronounce your name wrongly, but really thank you for you guys attending this webinar. Okay, that's all of today's webinar. Thank you. Bye.